Happy Friday, everybody. We hope you had a good week. Just wanted to follow up on something that we discussed a few weeks back, which is about the idea of should you go to cash or should you stay invested in the market? And now that we've seen the market bounce back a little bit here, there's this idea of should I get in? When should I get in? What is going on? Well, we know based on history that the return of the market is based on a very small number of days. Most days, there are very little up and downs. And then there are a few days where things go wildly up and down, right? There are big swings. And in order to take advantage of that, we need to be invested. If we are not invested, we cannot take advantage of that. And one of the things that's important to remember, especially about the stock market is a leading indicator. The stock market is a leading indicator. And so because of that, when the market is going down, that typically precedes trouble in the economy. Because if, as we have seen, there are policies being put in place that could put a damper on economic growth, the stock market is forward-looking. Stocks are valued based on forecast future cash flow discounted to the present. So if people see trouble on the horizon, they are going to lower their forecast for cash growth, which is going to reduce the present value of the price of a stock, meaning that the stock goes down. The same is true in reverse. So that if folks are looking forward and seeing that maybe this wasn't as bad as they thought, or maybe there is a recovery on the horizon, they're going to raise their forecast for future cash flow. Raise that future forecast of cash flow. That means the present value is going to be higher. Stocks are going to go up. And because of that, the stock market is typically going to turn around before the economy does. But if you are not invested, that's trouble because you are going to miss a lot of that growth, a lot of that rebound. And just think, if I have $1 and I lose 10 cents, and I've lost 10% of my money, in order to get back to having $1, I need to make a little over 11% to get back there. So I actually have to work harder to recoup, which means I need to be invested in the market, which is why we at Stratus really believe that even when things are going bad, our best opportunities are to be proactive when the market is going down and to buy undervalued assets. If stocks are going down relative to bonds, eventually there are going to be good opportunities to buy stocks. And that's exactly what we're looking at right now. Amanda and I are just doing some analysis about how we're going to start deploying cash over the rest of the year to take advantage of the fact that the stock market has come down and we can now get things on sale, right, at a lower price. So if you have any questions about this or anything else related to your portfolio or your investments, please send us an email, give us a call. We'd be happy to chat. Have a great weekend.